Welcome to my channel, Page. I'm sure you've heard the news. India's retail inflation has dropped to a 5-year low. This is welcome news for the economy. In March 2025, inflation fell to 3.3%. This decline was largely driven by easing food prices. Food prices rose by only 2.69% in March, compared to 3.75% in February. This easing of prices is a positive sign for consumers. It provides some relief from the rising cost of living. Lower food prices also help to keep overall inflation in check. This gives the Reserve Bank of India more room to support economic growth. The RBI is responsible for maintaining price stability in India. It sets interest rates and manages the money supply to control inflation. However, not all inflation indicators are showing improvement. Fuel, light, and core inflation have been on the rise. Core inflation, which excludes volatile food and fuel prices, reached around 4% in March. This suggests that underlying inflationary pressures may still be present in the economy. The Reserve Bank of India is facing a delicate balancing act. It needs to support economic growth while also keeping inflation under control. In response to moderating inflation and concerns about growth, the RBI recently cut its policy repo rate. This rate, which influences lending rates across the economy, was lowered by 25 basis points to 6% on April 9, 2025. The RBI's move signals its intention to maintain an accommodative monetary policy stance. This means that it is willing to keep interest rates low to encourage borrowing and investment. The central bank's current forecast for average CPI inflation in fiscal year 2025 to 26 is 4%. This suggests that the RBI believes inflation is likely to remain within a comfortable range in the near term. However, the RBI will need to closely monitor inflation trends, particularly in light of rising global commodity prices. Further rate cuts may be possible if inflation remains subdued, but the RBI will need to be cautious not to fuel inflation by keeping interest rates too low for too long. India's merchandise exports showed modest growth in March 2025. Exports rose by 0.7% year-on-year, reaching $41.97 billion. For the full fiscal year 2025, total goods exports amounted to $437.42 billion. This represented a marginal increase of 0.08% compared to the previous fiscal year. However, India's import bill has been growing at a faster pace. Imports surged by 11.3% year-on-year in March, widening the country's trade deficit. The trade deficit, which is the difference between exports and imports, reached $21.54 billion in March. This growing trade deficit is a concern for India's economy. Morgan Stanley, a global investment bank, has revised its growth forecast for India downwards. The bank now expects India's economy to grow by 6.1% in fiscal year 2025 to 26. This is lower than its previous forecast. Morgan Stanley attributes this revision to several factors. These include shifts in trade and tariff policies, which are impacting external demand and investment. India's economic performance is influenced by global economic conditions. China, a major economic powerhouse, has reported strong economic growth in the first quarter of 2025. China's GDP grew by 5.4% year-on-year, exceeding market expectations. Meanwhile, the United States continues to implement trade policies that are impacting global trade flows. Proposed U.S. tariffs on certain goods, including semiconductors, have raised concerns about potential disruptions to global supply chains. These tariffs could also lead to higher prices for consumers and businesses in the United States and other countries. India and the United States are currently engaged in bilateral trade agreement negotiations. These negotiations aim to enhance trade and investment ties between the two countries. The outcome of these negotiations could have significant implications for India's economy. If you like content like this, please consider liking, sharing, and subscribing.